For centuries, there's been this persistent financial story, a myth almost, that gold can somehow predict economic disaster, that it's a crystal ball for the rich, a secret signal telling them when to head for the hills while everyone else gets left holding the bag. But what if I told you that's not the full story? Is the real relationship is much more intimate and much more revealing. The truth is, gold doesn't predict the collapse. Its rise is a symptom that the collapse has already begun. In this video, we're going to tear through 300 years of history, from the Great Depression to right now, to show you the proof, the pattern that governments and central banks would rather you not notice. You're about to learn one of the biggest secrets in the history of money. It's a truth that explains why countless paper currencies have failed, and why the one asset that has outlasted them all is sending a massive warning right now. To really get gold, you first have to understand the flaw baked into the money you use every day. Before we had the dollars and francs we know today, money was mostly gold and silver. Real, tangible stuff. Its value was obvious. A country couldn't just print more of it out of thin air. This built-in limit, what we call a gold standard, forced governments to be disciplined. But powerful institutions aren't big fans of discipline. They want control. So, one by one, they cut the cord. They brought in fiat currency, money backed by nothing more than the government's promise that it's worth something. And just like that, they gave themselves a magic checkbook with no spending limit. Ever wonder why everything, from your groceries to a house, seems to get more expensive over your lifetime? It's not that all those things are suddenly more valuable. It's that the money in your pocket is constantly being devalued. This is the sickness of our modern financial system. It's a quiet, creeping confiscation of your wealth through inflation, a process fueled by endless money printing and the piling up of debt that can never be paid back. This is the fundamental problem. And gold is the fever. It's your body's warning sign that the sickness is getting worse. A fever doesn't tell you that you're going to get sick. It tells you that you are sick. The higher the fever, the worse the illness. And throughout history, whenever this financial sickness has hit a critical stage, gold's fever has spiked, signaling a crisis isn't just on the horizon, it's already here. Let's go back to the biggest economic collapse of the 20th century, the Great Depression. The story you were probably told is that the 1929 stock market crash was the cause. But the crash was just a symptom. The real disease was a collapse of faith in the entire banking system. In the years after the crash, thousands of banks across the US failed, taking people's life savings with them. In that climate of pure fear, where did people run? They ran to the one thing they knew was real gold. They rushed to the banks to trade in their paper dollars for physical gold, which was their right. The US government watched in horror as its gold reserves started draining away. So, what did they do? Did they fix the underlying problem? No. They just changed the rules of the game. In 1933, President Franklin D. Roosevelt signed Executive Order 6102. This order made it illegal for American citizens to own most gold. That's right. They forced people to turn in their gold to the Federal Reserve for paper dollars at a fixed price of $20.67 per ounce. But here's the heist. Here's the part they don't teach you in school. Once the government had vacuumed up the people's gold, what did they do? The very next year, with the Gold Reserve Act of 1934, Roosevelt immediately jacked up the official price of gold to $35 an ounce. Let that sink in. They forced you to sell your gold for $20, and then, almost overnight, they declared it was worth $35. With the stroke of a pen, they devalued the paper dollars everyone was now stuck with by over 40% against gold and massively increased the value of the gold on the government's own books. This wasn't gold predicting a collapse. The collapse was in full swing. This was the government seeing people run for the financial fire escape and slamming the door shut. It was a massive wealth transfer from the people to the state, all done under the cover of a crisis. And it taught the powerful a lesson they never forgot. When the system breaks, they rewrite the rules to save themselves, not you. This cemented gold's role not as just another investment, but as financial life raft in a corrupt system. After World War II, the world operated on a system called Bretton Woods. The US dollar was crowned the world's reserve currency, supposedly as good as gold because other countries could, in theory, swap their dollars for US gold at that fixed $35 an ounce rate. This put America at the very center of the financial universe. But the US had that same old temptation, the magic checkbook. To pay for the Vietnam War and huge social programs, the government printed way more dollars than it had gold in the vaults. Other countries, especially France, saw the writing on the wall. They knew the US was writing checks it couldn't cash, so they started showing up and asking for their gold. And once again, America's gold reserves started bleeding out. By August 1971, President Richard Nixon had a choice: either impose harsh discipline, cut spending, hike taxes, and trigger a nasty recession to save the dollar, or, you guessed it, change the rules. He changed the rules. On August 15, 1971, Nixon went on TV and announced he was temporarily suspending the dollar's convertibility into gold. That temporary suspension is now over 50 years old. That was the day modern money as we knew it died. It was the moment the entire global financial system was officially cut loose from anything real. From that point on, all major world currencies became pure fiat currencies, their value based on nothing but faith and the decisions of central bankers. And what did gold do? It was finally unshackled. Free from government price fixing, it began to act as a true fever chart for the health of this new global fiat experiment. During the stagflation crisis of the 1970s, a brutal mix of high inflation and a dead economy, the price of gold exploded. Throughout the 1973 to 1975 recession, the price of gold surged an incredible 87%. It was screaming that this new system of pure paper money was dangerously unstable. But the story isn't always so simple. In the early 1980s, the Federal Reserve, led by Paul Volcker, fought back against inflation with punishingly high interest rates. During the short recession of 1980, gold actually fell by about 5%. This showed that while the bankers couldn't cure the disease of currency debasement, they could sometimes suppress the fever with the strong medicine of high rates. But that medicine has brutal side effects like deep recessions, and it's a trick they can't pull off forever. The turn of the 21st century gave us the clearest proof yet of gold's true role. Let's look at the two biggest collapses of our lifetime: the 2008 Great Financial Crisis and the 2020 COVID crash. This is where the pattern becomes impossible to ignore. First, 2008. The crisis didn't start when Lehman Brothers collapsed in September. The sickness had been festering for years in the subprime mortgage mess, and gold's fever was already climbing. It started a steady rise in 2007, breaking $1,000 an ounce for the first time in early 2008, whispering that something was deeply wrong. Then Lehman went down, and all hell broke loose. And what happened to gold in the immediate panic? It fell. In the chaos, as the crisis peaked, gold sold off by around 30% from its high. Why? Because in a true liquidity crisis, everyone sells what they can to get their hands on the world's lifeblood, cash, specifically US dollars. They sell stocks, they sell bonds, and they sell their winners, including gold, to cover their losses. This is the part of the pattern most people miss. The initial shock of a major collapse often causes a temporary dip in gold. But what happened right after? As the Fed and central banks fired up the money printers like never before, slashing rates to zero and launching quantitative easing, gold reversed course and began a historic rally. While the S&P 500 lost around 37% in 2008, gold finished the year with a gain. By 2011, as the consequences of all that money printing became clear, gold had more than doubled, hitting over $1,900 an ounce. Now look at the 2020 COVID crisis. It was an almost perfect replay. For a couple of years leading into 2020, gold was already trending up. Then, in March 2020, as the world locked down and markets panicked, we saw the same mad dash for cash. Gold suffered a sharp, dramatic sell-off. But once again, what happened next? Governments and central banks unleashed the single biggest flood of stimulus and money printing in human history. And gold, right on cue, took off like a rocket. Just a few months later, in August 2020, it surged to a new all-time high of over $2,070 an ounce. Are you seeing the pattern? It's not a simple rise before a collapse. It's more like a three-act play. The fever, gold rises steadily as the underlying problems. The debt, the bad investments, the quiet currency debasement, get worse. The shock, a sharp, temporary drop right when the crisis goes nuclear, driven by a desperate scramble for cash. The response, a powerful, sustained surge as central banks inevitably solve the crisis with the only tool they have, printing more money, which debases the currency and makes gold shine brighter than ever. So, here's the truth behind the old myth. The idea that gold always rises before a collapse is a dangerous oversimplification. History shows it sometimes falls right before, or during, the most intense part of a crisis. The real secret is this. Gold's price isn't a crystal ball. It is a fever chart for the health of our money. It is the ultimate lie detector. Gold doesn't predict the crisis. Its behavior reveals the crisis as it unfolds. It's the canary in the coal mine. And for decades, that canary has been singing louder and louder. Its steady climb in the good times measures the slow motion decay of our paper currencies. That sudden dip during peak panic is the system gasping for cash. And its explosive rally afterward is the market's final verdict on the so-called solution from central banks. It's the market screaming that printing trillions of dollars isn't a cure. It's just a more powerful dose of the original disease. Every time a crisis hits, the authorities tell you they've got it under control. But then you look at the price of gold, and it tells you the real story. It tells you they're just destroying the value of your money to paper over the cracks in a broken system. To paraphrase what the famous financier J.P. Morgan once told Congress, gold is money. Everything else is credit. That has never been truer than it is today. Gold is the final judge of value when all other forms of credit and trust break down. If you're finding this trip through financial history valuable, and you want to keep learning how the wealthy really protect themselves, make sure you subscribe and hit that notification bell. This is the kind of knowledge that gives you an edge. So, where does that leave us today? As we stand here in late 2025, the world is swimming in more debt than ever in human history. Geopolitical tensions are flaring, threatening the global trade that holds everything together. And central banks, after a brief and painful attempt at discipline, are signaling they're getting ready to cut interest rates again to keep the whole system from seizing up. Look at what the central banks themselves are doing. They are buying gold at a historic pace, a structural shift away from the US dollar as they try to protect their own reserves. They are telling you, with their actions, that they are losing faith in the very paper assets they tell you to hold. The fever is rising again. This year, gold has surged to stunning new highs, blowing past previous records. Some will call it a bubble, but is it? Or is gold just doing what it has always done, reflecting the unprecedented level of risk in our system? The historical pattern is clear. The final act of this drama isn't written yet, but gold's performance isn't a prediction of the future. It is a real-time diagnosis of the present. And right now, that fever chart is telling us the patient, our global financial system is sicker than it has ever been. The question you have to ask yourself is, when the next shock hits, will you be holding the paper promises of a struggling system? Or will you be holding the one asset that has survived every single collapse for 3,000 years? The choice is yours.